What is going on? Nobody knows, but we're going to answer a ton of questions and see if we can't figure it all out. All right, so Stefan Schumacher asks, what caused the blowout in the 10-year yield last week? This one's complex. There's a lot going on here. I talked to a ton of people. I talked to traders in Japan. I talked to traders in Manhattan, some of the biggest bond traders in the world. The story is really conflicted. Nobody knows the exact right answer, but the three big theories were basically a big hedge fund blow up. Some people think there was a big hedge fund in Japan that blew up. The other theory was the basis trade unwind, that hedge funds were kind of over levered to the basis trade, that they had to unwind this position. So there was a steady sort of sale of the 10-year bond because of that. The theory that I think is the most convincing, that at least the one that probably played the biggest role, I think all of these things probably played some role to some degree, but it's a general aversion to US dollar denominated assets. And so the basic theory here is that if we have big tariffs and we're going to be basically trying to reverse the big trend in the current account deficit, meaning the amount of dollars that have been outflowing from the United States, what's happening is a huge portfolio rebalancing effect where foreign governments and investors as a whole are rebalancing their portfolios in anticipation of this. So less dollars flowing out of the United States means that foreigners are going to have fewer dollars to reallocate into US dollar denominated assets in the future. And that just means that the portfolios are going to look way different in the future. There's going to be a lot less demand for US dollar denominated assets in the future. And this resulted in this sort of steady, methodical, really sale of US government bonds last week, where this was really just a function of predicting where this is all going in the future. And it all just kind of happened all at once for the most part. So I don't think this was necessary. There were some people saying that part of this was like an attack from the Chinese on the US government bond market. I think the most convincing theory that I've heard is just that there's going to be less demand for US dollar denominated assets because of a potential reduction in the current account deficit. And that just means that there was a huge portfolio rebalancing effect. So I don't know if this is something that's necessarily going to persist, but I think that the action last week was indicative certainly of something that investors are preparing for, less demand for US government bonds and US dollar denominated assets as a whole. All right, John G asks, why are tariffs bad in the short term? So the basic gist of why tariffs are bad in the short term, it's yet to be seen whether tariffs could potentially be good in the long term. The theory is that, of course, this reshuffling could be good for us in the long term, and Trump says we just need to endure some short-term pain. But the reason they're damaging in the short term is really basic. Tariffs are a tax on corporations that they will pass on. So ultimately, businesses have to, and consumers have to figure out, how are we going to adjust to this tax increase, this price increase that's going to happen in the short term. The second reason tariffs are bad in the short term is because they're causing a huge amount of uncertainty. So all this business uncertainty that we're seeing is the result of businesses don't know what the prices of things are going to be. And the way this is being implemented is sort of haphazard and changing every minute of every day, seemingly. So there's a lot of uncertainty, which means that businesses are not investing as much as they otherwise would. They can't plan for the future, and that's disruptive in the short term. And then the final reason is that it looks like we're diminishing a lot of relationships on the global stage. So we're sort of isolating ourselves to some degree. And that's going to reduce demand from foreign governments for everything that Americans sell. And so all of this is disruptive and negative in the short term. It's yet to be seen how disruptive it will end up being in the short term, and especially whether it will be disruptive in the long term. But it's certainly, those are the three primary reasons why this has the potential to be highly disruptive in the short term. Golden Rule LLC asks, where are we headed over the next 12 months to 2 years? These are short time horizons to me, and this is all assuming that the tariffs remain in place. Me personally, I think that the baseline assumption from the tariffs is that these are harmful to growth. And so if we really continue to press the issue on this, I think that the baseline assumption for me is that we're probably veering into, at a minimum, low growth, probably marginally negative growth in the next few quarters. whether this causes a recession depends on how disruptive all of this ends up being and how large these big tariffs end up actually being enacted. So it's all shifting every single day. So we don't really know the answer at all this. But I think the baseline assumption is that this is all at a minimum marginally contractionary. So I would assume that over the course of the next 2 to 3 quarters, corporate America and consumers have to sort of digest all of this. And we'll get beyond this at some point, but in the short term, this is all super disruptive. There is an outlier scenario where we really press this issue and it ends up being a lot more disruptive than people even expect. And I think that in that scenario, the economic data is going to start to bear itself out with time. And as we see either the unemployment rate tick higher, or we start to see inflation from this, or if we start to see the stock market move a lot lower and bond yields, for instance, moving higher in anticipation of even higher inflation than expected, then I think that policymakers are going to get forced to backpedal on this. And either the evidence is going to make them backpedal, or at some point Congress potentially has to step in and actually remove the tariff policy power from Trump. And in that sort of a scenario, Congress has to get 2/3 vote in both houses. And then that's the really, really messy scenario where you have to rely on Congress. But that's probably the outlier scenario. But I would say at a minimum, the baseline assumption here is that growth is going to be pretty meager if these tariffs are left in place for a protracted period of time. All right, Amiralek asks, does the rise in yields reflect the elimination or decline in American exceptionalism? And this is the whole theory that America, and especially American corporations, are exceptional, that they do everything a little bit better. And the evidence, especially in the last 5 to 10 years, certainly was consistent with that we were outperforming every GDP nation in the G7, and obviously our stock market just kind of has been trouncing everybody for a long time, and as a share of market cap around the whole globe is just gigantic. It's 60% plus of the entire world global cap. But does this signify the end of American exceptionalism? I would say no. This does, however, reflect a marginal reduction, I think, in the relative standing of America against the rest of the world. And I think that that's going to be reflected not only in the future valuation of our asset classes relative to the rest of the world, but it's going to be reflected in the way the currency is performing and things like that. So I think it's a little extreme to start jumping to the conclusion that like reserve currency status is going to be lost, or that this is the end of the world for the American exceptionalism and American dominance. U.S. corporations are, in the long run especially, going to continue to be some of the most innovative, productive entities in the whole world. I don't think any of that is going to change, but I do think that this potentially marks an important sea change in the relative standing, where the rest of the world has been poked, and I think they're waking up to the reality that they can't rely on the United States quite as much as they once did. And I think that's going to narrow the gap in this relative exceptionalism versus the rest of the world going forward. Leviatano asks, is this a routine drawdown in the stock market, or is this time different? Well, I certainly hesitate to say the most famous words in investing, which is it's different this time, but it's always different this time at the same time. So I think that this is something we've never really seen. We are potentially shaking up the entire global monetary system and the centrality of the dollar within that system. So it is important to, I think, put that into perspective, but at the same time, the way that the stock market is going to perform is very contingent on, I think, the way that this is unfurled over the course of the next 6 to 12 months. I think that if Trump really presses this, if we really close everything off to the rest of the world and we really pull back in a big, huge nationalistic move, I think that has the potential to definitely turn into an anomalous sort of event where this is going to be a lot more harmful in the short term than a lot of people probably expect. So it totally depends on the way that this is implemented. I think that if tariffs do end up being, in place to the extent that they are presently, that has the potential to turn into something much bigger, because this is a very, very fundamental event in terms of the way that a stock market correction compares to a something like a bear market. A correction is typically just something that is disruptive. Say corporate earnings decline because growth slows a little bit. The stock market corrects 10% and then usually adjusts backwards to, over the next few months or quarters back to where it was more or less. Whereas a bear market is something much more fundamental. It is something more like COVID or the great financial crisis, where something is shifting in the underlying dynamics of the global economy that's very fundamental to the impact on corporations. And this certainly has the potential to turn into something like that. I wouldn't say it's my baseline, and especially predicting the short term is virtually impossible, but this is certainly a very fundamental event. So if you're not prepared to undergo some discomfort over the course of the next 24 to 36 months, that could be a big problem for you, because although it's not my baseline expectation, I certainly wouldn't say it's out of the realm of possibility here. Kyle Lafferty asks, is now a good time to be buying long duration bonds? I can't give personal financial advice here, obviously. Everybody has their own personal needs and whatnot. In general, I'll tell you as a framework, I view long duration bonds very specifically as a specific type of insurance against deflation across the relative protection that the yield curve can provide you. So long duration government bonds tend to perform best when inflation is either falling or we have outright deflation. And so if you have like a recession or a GFC type of environment, those are the environments where super long duration bonds really perform well, because interest rates come way down and you get this huge outperformance in the most interest rate sensitive instruments, which is long duration bonds. And so if you think a recession is potential, and you think that deflation is potential, then yeah, you probably do want to be owning some longer duration bonds. In general, though, I think of bonds as being very specifically, they're principal protection instruments across specific time horizons. So for instance, Treasury bills, we talk about bonds in this all encompassing sort of term sometimes. And, it's really, in the government bond market, bonds are technically long duration instruments, whereas bills and notes are shorter. But, so there's some jargon confusion in all of this. But in general, I would say that it's better to think of things like Treasury bills as those are very temporally certain in terms of principal across very short time horizons. So like 0 to 2 year time horizons. And then things like Treasury notes, 3 to 10 year notes typically are they're very price insensitive across those specific time horizons. That doesn't mean they're going to protect you from inflation, but it does mean that from a principal perspective, you don't have to worry about how many dollars you're going to get back if you're buying those instruments across very specific time horizons. And for me, long duration bonds, they're not the same thing, because if you have a 30-year time horizon, for instance, I say you should just be buying stocks. Stocks are going to protect you from a principal perspective and from an inflation protection perspective much better than long duration bonds will. But if you do think that recession or deflation is an increasing risk in this sort of an environment, long duration bonds have a role, but think of them as insurance specifically. So insurance is never the central piece of a portfolio. It's always this tangential piece that it protects from some outlier event. And I think that that's the right way to think of Treasury bonds and long duration bonds in general. All right, Snakes and Ladders asks, what will the Fed do if yields continue to spike? I think they're going to intervene. If things got really, really nasty in the bond market, I think that the Fed would probably come in and start to implement yield curve control. They would probably they would cap the long yield. They'd probably start buying 10-year bonds again. And the Fed is the big gorilla in the bond market. The old saying is that if you come back, you want to come back as the bond vigilantes. But really, if you come back and you want to control and scare everybody, you want to come back as the Fed, because the Fed is the entity with the big bazooka. They're the one with the bottomless money printer. And if they come in and they want to smash interest rates down to wherever they want, they could control the entire yield curve. They could come in and buy back every single bond that's outstanding. They could pin the whole yield curve down to zero and set interest rates to zero across the entire curve if they really wanted to. So I thought it was interesting last week when Besant didn't come out and say anything in response to the yield curve increase, because me personally, if I was Treasury Secretary, I probably would have come out and said something about managing the supply. The Treasury is not powerless in all of this. The Fed is they've got the big bazooka because they're the price setter. They can come in and set the interest rate, but the Treasury is no pushover. The Treasury controls supply. So I was a little surprised that Besant didn't do something like that. At least, we call it open mouth policy with regard to Fed policy. Sometimes they just have to say things. It's the old Chuck Norris theory that, Chuck Norris doesn't have to actually kick your butt. Chuck Norris just has to come in and say, I'm going to kick your butt. And then you get scared and you back off. And the Fed oftentimes does that with open mouth policy, where they can threaten something and get the market to move just by threatening something. And I was a little surprised that Treasury didn't do that. But I do think if this gets a lot worse, if yields were to continue to behave really erratically and kind of like they did in the early part of COVID, I think they would do the same thing that they did during COVID, where they come in and they start saying, look, we're going to cap yields. We don't care maybe what's happening with inflation, but this disruption in the bond market is now over. So I think that if things get bad enough, they're going to come in and they're going to start controlling the yield curve. All right, Dave Fuegi asks, gold, what next? Who knows? Nobody can predict the short term with crazy assets like gold or stocks or anything that is highly volatile. But I will tell you that the way that I view gold, again, is sort of similar to the way that I like to view Treasury bonds, in the sense that Treasury bonds are these long duration deflationary insurance. Gold, to me, is a long duration fiat currency insurance. So gold is inherently a long duration instrument because it's utilized in the means of production over very long time horizons. But I also think that gold is the oldest form of money. I don't think gold is a very good form of money, but it is viewed historically as the longest form of money that's really ever existed. And so I think people inherently view gold as a long duration form of money, and central banks certainly view that in the terms of the way that they buy it and store it and utilize it for their own sort of insurance-like purposes. But I would view it very specifically as this form of insurance. And so if you think that something highly disruptive is going on in the fiat currency system, which it obviously is, then gold can play this sort of outlier role as a form of insurance. But I do think that's an important framing, is that you don't want to view gold as like the central piece of your portfolio. It's not a reliable cash flow generating instrument that you can rely on to generate, say a financial planning based outcome over the course of short and intermediate term time horizons. But at the same time, it does have an insurance-like feature to it, where an insurance is a perfectly acceptable part of any financial plan, of course. And I think that gold can play this sort of insurance-like aspect for a portfolio when it's utilized in this very specific sense. So as fiat currency insurance, I think gold is perfectly fine. And I would think that in this sort of an environment, there is a decent probability that gold continues to operate like that, because this sort of event is so disruptive specifically to the fiat currency system. All right, Joe asks, you get a huge lump sum of cash today. Where do you invest it? Again, super personal question. I personally, the framework that I utilize in my personal assets is very temporally based. So I call it defined duration investing. And what I've done basically is I've quantified the duration of different instruments. So like the stock market in my framework is an 18-year instrument. Gold is a multi-decade instrument, 30 years or so. Things like a 60-40 portfolio come out to roughly a 12-year instrument. But you can quantify all these things. And then if you work with a financial planner or from a financial planning based perspective, you can then start to match assets to liabilities, much in the same way that like a bank operates, or a lot of big pension funds operate the same way. And I'm just utilizing it more at like a personal level. So I would say that, as a sort of really simple example, if you have $1 million and you say you want, maybe you've got $100,000 of annual expenses and you want a 2-year emergency bucket, you're going to put $200,000 down for a home down payment at some point in the next 5 years. And the rest of it is sort of unknowns over the intermediate or long term. Retirement funds, maybe you're sending a kid to college in 10 years. Well, start with the short-term stuff, bucket out for 2 years of expenses. So you would put 200 grand in, say, something like Treasury bills. You put another 200 grand in, say, 3 to 4 or 5 year intermediate government bonds for that house down payment. That's going to clip hopefully a little higher return, but over a little longer time horizon. And then you can fill in the other buckets sequentially as you go out, depending on your needs. But for me, that's how I would approach all of this. I don't like the idea of putting everything into one big bucket and thinking of it in the traditional diversification terms, where we think of our entire portfolio as one big blob of assets. I like a much more quantifiable sort of bucketing style approach where I can look at my assets in a certain environment like this and I can say, I got 2 years of expenses fully covered. I don't even care what the stock market does. I don't even care what gold or all those long duration instruments do in the short term, because I know that I'm covered. I'm insured by my treasury bills or my short-term government bonds, where I kind of know with a very, very high degree of certainty what my ability to navigate the uncertainty of the next few years is going to look like. All right, Alan Severud asks, will tariffs cause inflation or deflation? This is the big question for everybody, I think, over the course of the next few years. And I think that from a proper perspective, tariffs don't cause inflation, meaning that unless tariffs are implemented and then increased nonstop over the course of time, they don't cause inflation. Inflation is a consistent rise in the price level due to some, lasting policy impact. And so, things that typically cause proper inflation are things like increases in the money supply or a sustained decline in supply, things like that cause a sustained increase in the price level over time. And what tariffs do is more acute. Tariffs cause really a one-time bump in the price level that should subside with time as we sort of learn to evolve and adapt to the change in the way that we're producing goods and services. So I would say that the sort of baseline assumption with all of this is that you're going to see probably a one-time increase in the price level due to a lot of this. And then the rest is going to unfurl based on how much can consumers really adapt to that? Can they actually eat the whole price increase themselves? Or what we're really seeing with the stock market these days is that the stock market looks like it's reacting more in a sense where the stock market and corporations are going to eat a lot of this cost. So there's going to be a lot of, I think, both. If you get a big recession, I think ultimately this is going to cause maybe not necessarily proper deflation, but it will cause disinflation, meaning that that's a falling rate of positive inflation, basically. That is certainly in the long run is my base view. So I wouldn't be shocked if we got sort of an intermediate bump in some of these inflation readings, but ultimately in the long run, I think that a lot of this is disinflationary because it's so disruptive to investment in businesses that I think that is going to offset a lot of any potential price level increase that we see, because we're going to see lower consumption, we're going to see lower business investment. There's the potential that if you do get unemployment from all of this, that is certainly going to be disinflationary and potentially deflationary at some point if it were to get really bad. So a lot of this depends on time horizons. I think over the course of multiple years, you're looking at disinflationary impacts. In the short term, you're potentially looking at a one-time increase in the price level, which some people might call inflation, but really is technically not inflation. So Intelligent Yet Idiot, great name by the way, says, I'm stuck at the squat rack. Please tell us when we get some relief. So this is my ongoing joke that you have to do leg day anytime the stock market is down 1% or more, and there's been a lot of that lately, so I've been at the squat rack a lot lately. But in all seriousness, I would say that if you're stuck at the squat rack, you probably want to start building a roof. You probably need a bed close by. If you can't get out of your squat rack, then that's not a huge problem. There's worse places to be in the world. But I would say that like the Marines, you got to embrace the suck. You got to live in the moment and really get those legs going and get strong. Know that in the long run, this is all going to subside. But when you come out of it, your legs are going to be friggin' blasted. They're going to be gigantic, and you're going to be able to conquer the world, knowing that you didn't skip leg day like Chamath and some of the other guys who are walking around with their little chicken legs. Ben Music says, my wife is newly retired and bonds don't look like a safe haven anymore. How can she reduce her sequence of return risk? So sequence of return risk is when you are, for instance, retiring and you have this acute temporal risk of, say, the stock market crashing, and a sudden jarring event reduces your balance where you're not able to navigate your expected withdrawals and things like that. And I think in this sort of an environment, I hesitate to submit to this sort of narrative that bonds are no longer the safe haven that people think. I think a lot of people are reading way too much into last week's performance. I mean, for instance, US government bonds are still up 2.5%. Intermediate government bonds are up 2.5% this year. So even though they didn't perform great last week, I mean, these are, by definition, these are longer duration instruments. You can't judge a 10-year bond over a 10-day period and make any sensible conclusion from that. So I think that looking at it from a longer perspective, I would fully expect bonds to continue to operate with a certain degree of principal stability, but you've got to view them as the properly long duration instruments that they are. If you don't want or feel comfortable with that type of certainty over, say, a 10-year period, though, for a 10-year government bond, well, you've got to go shorter. This is one reason why I hate aggregate bond index funds, for instance, is because you take all the different durations and maturities and you mash them all into one instrument and you create what's called a constant maturity, where you don't actually have certainty of principal over any defined duration inside of that portfolio. So I'm a big advocate of ripping those things apart, disaggregating them. And if you need certainty over specific time horizons, you've got to rip that thing down and take out the Treasury bills, for instance. If this environment makes you really, really scared, I don't think there's anything wrong with, for instance, if you've got 40% of your portfolio in government bonds through a bond aggregate, for instance, there's nothing wrong, in my view, in taking 15% of that chunk, ripping it out, and buying Treasury bills with it and creating the short-term temporal certainty that you need or want to navigate this sort of an environment. But this is not really a market timing move so much as it's disaggregating that component and then maintaining that same sort of asset allocation you have, where you still have 40% in fixed income, but now you're creating a lot more temporal certainty so that you reduce some of that sequence of return risk that is so acute inside of these time horizons where somebody, for instance, might be retiring right now. All right, La Flama Blanca asks, what's your view on small cap value in the current situation? Again, we're talking about long duration instruments like stocks over short time horizons, which I don't think is the best way to compartmentalize these things. I think that, again, you've got to think of your short-term instruments as very specific instruments like Treasury bills, money market funds, CDs, high yield savings accounts, whatever it might be. Those are very, very different animals than, say, the stock market, which is an inherently long duration instrument. That said, this is what we call a factor tilt. The factor investing advocates will argue that there are certain factors that define how there's certain levels of outperformance in certain components of the market. And there's a lot of evidence that small cap value in general can potentially provide some outperformance in the long run. And I've softened my tone on factor investment. I used to sort of be somewhat militant against it, but as the fees have come down and these strategies have been improved a lot, I don't think there's necessarily anything really wrong with tilting a portfolio a little bit to a factor, especially if from a behavioral perspective, it helps you sort of stay the course in the long run. So I've got no problem with buying small cap value, especially if you're diversifying internationally in this sort of an environment, because this this environment has the potential to be this sort of secular change in the dollar where you're buying international small cap value, for instance. That has the potential to sort of be a double hedge where you're not only hedging against some of, for instance, like the large cap domestic risk that is now present in the US stock market, but you're also hedging a little bit from the currency risk that's inside of the portfolio, because you're, by owning the foreign stocks in this sort of a strategy, you're getting a little bit of a dollar hedge if you're a domestic US dollar investor. So I got nothing wrong with these factor tilts, and I like small cap value for the most part, but I would say that you can't think of it inside of this specific environment so much as you have to think of it as what it is. These are long-term instruments. You've got to put them in your long-term buckets and view them properly inside of that perspective. All right, Irving Fisher asks, when are we going to see housing deflation? Falling house prices, how likely is that? Gosh, I mean, I'm not super optimistic about residential real estate over the course of, say, the next 5 to 10 years. And that's mainly because the current structure of interest rates is so punitive. The cost, we got this huge boom in housing prices, and then the surge in interest rates following COVID. That was sort of a double whammy for new buyers, but it also locked a lot of people into their house. So like I have a 2.5% mortgage, which it makes it very, very hard to convince myself that I should ever move in the future, because the relative change in my mortgage cost would be just gigantic. And there's millions of people with these so-called golden handcuffs on right now. And so I think that the dynamics for housing don't look that great, because there's just not enough demand formation there, because it's so hard to access the mortgage market right now. But this could all completely change, especially if you got a decent sized recession. I think that you wouldn't necessarily see house prices fall, but I think you would see more of what we've been seeing sort of in the post-COVID period, where house prices are really sort of stagnantly growing. But then if interest rates come in a lot, there is a ton of pent-up demand. So I would argue that my baseline case is, if interest rates stay where they are right now, that we're more likely to see just sort of stagnant real estate, not necessarily deflation, but we're going to see the differential between rents and house prices sort of converge over time, meaning that rents are going to get more and more expensive, and the house prices will sort of stagnate. But I think that if you get an environment here where you got a proper recession and you got the Fed coming in and really reducing interest rates, I think that has the potential it would be disruptive in the short term, but in the longer term, I think that would probably cause potentially a big boom in real estate, where if you got interest rates down to, say, 2%, you get a ton of people who all of a sudden can tap the mortgage market. That brings in a huge flood of demand. And with the inherent sort of supply problems we have in housing, I think that actually has the potential to put upward pressure on house prices in the longer term. So that is totally contingent on what happens with the Fed and interest rate policy. But my baseline is more for stagnant real estate, not necessarily a deflation. I actually think the likelihood of a proper deflation and really sharply falling real estate prices is relatively low, just because you don't have the supply dynamics here that are consistent with really destructive falling price environments. All right, Joshua Saddleridge asks, is the US dollar weakness a reality check with trillion-dollar deficits and the theory of MMT, which you partially agree with? First of all, Joshua, I am not a huge advocate of MMT. I went through a period during the financial crisis there where I agreed with a lot of what the MMT people said, because I think that the narrative back then was that we were going to get hyperinflation due to QE. I think the MMT people get the banking system largely right in terms of describing how money is created inside of the banking system. And I think they get the inflation narrative around governments, especially like the United States, correct, in the sense that the US government has an inflation constraint. The US government is not going to go bankrupt and run out of money because it can print money. And so the MMT people get a lot of that stuff right. The MMT people also get a huge amount of stuff wrong. So I've written, they are not big fans of mine at the moment, because I've written a lot of relatively critical work, because I think they go in some sort of wacky extremes, I think, to some degree. But to your question, really, I think that the US dollar weakness is just, this is a policy maneuver. This is very strategically intentional by the Trump administration, where they're trying to weaken the dollar. Everything they're doing is trying to weaken the dollar to make us more competitive on the global trading stage. And so I don't think this is so much a function of the market saying, we don't think the US government can afford its deficits or something like that. Like, people have been saying we're suddenly trading like an emerging market, which I kind of think is that's too extreme. The US government is, or the US economy is so far from an emerging market that, and 1 week of trading certainly does not, prove anything like that. And so I would say that no, this is more a very specific policy agenda, that the dollar weakness is very specific. It's part of a trade policy to make us more competitive with the rest of the world, close our current account deficit, and reduce our balance of payments relative to the rest of the world so that things are more competitive on a global stage. All right, Certain Shakespeare asks, what does the future of the US dollar look like with tariffs if they remain? I think that this is, again, it's a temporal thing. I think this is very short-term disruptive. The dollar is potential to be under pressure over the short term, but in the long run, I really don't think any of this is sustainable. I don't think the tariffs are that sustainable. I don't think you can fight globalization in the long term, because the world's just becoming a really small place mainly because of technology. We're much more interconnected because of this. And I think that nations can try to fight this, but I don't think this is not a trend that I think you can just reverse or overcome. This is something that's been in development for 100 years at this point. And I think going forward, the likelihood is that the world's going to get even smaller. And so our ability to trade with foreign governments and benefit from that, foreign economies, is beneficial in the long run. And I think the overwhelming evidence proves that across the history of free trade, and just the history of the growth of globalization. So I would say that in the short term, this has the potential to be very disruptive for the dollar. In the long run, I think that, especially if you get to a next presidency, I don't see any of this being all that sustainable. And so I don't think that this narrative that we're seeing a complete change in the framework of the global monetary system, I don't think that's very sustainable in the long run, but it has the potential to be hugely disruptive in the short term. HV asks, is the US dollar losing its reserve status? Should we all move to gold? Well, no, certainly you shouldn't move all in or all out of anything in your portfolio. I think that's sort of antithetical to the whole point of diversification and whatnot. But I think from a dollar reserve status, I think people get the causality wrong with dollar reserve status. The dollar is the dominant reserve currency mainly because our corporations are so productive. The domestic economy ends up being so wealthy because of this that we just consume a huge amount of stuff around the world. And so, I often talk about how the median American is in the top 10% of global wealth. Americans are just unbelievably rich, and that's in large part because our corporations are so productive. And reserve status is a function of that we do a lot of business with the rest of the world. And so they end up with a lot of dollars. And that's why they hold dollar reserves. It's not because of, people talk about Bretton Woods and the petrodollar and all these sort of mythical things. And those have some impact on dollar demand to some degree, but they're not the dominant driving factor. And so in the future, do I think that ultimately US corporations are going to become like less productive or, less dominant? Maybe on a relative sense, but I don't think that we're on the verge of like a dollar reserve collapse or something. You may continue to see this sort of relative shrinkage in terms of the amount of dollars that are held abroad because of these, impactful policies in the short term, especially. But in the long run, I don't think that this is going to be disruptive in the sense that I don't think that US corporations are going to lose their ability to dominate across certain industries, or that Americans are suddenly going to stop being innovative and productive and hugely wealthy in a relative sense around the world. All right, Mark Dawes asks, how do you assess the risks of the 10-year? And dive into details if you can. Well, gosh, I view the 10-year yield as basically an expectation of 10-year Fed funds rate plus a small premium. So for instance, right now, the 10-year yield is at like 4.35%. I would say that that's consistent with the market expecting for instance, the Fed funds rate to be at like 3.5% plus a small premium over the course of the next 10 years to account for the uncertainty of the time horizon. So the market is pricing in a small premium to that expectation. So I would say that, they're expecting interest rates to fall over the course of the next 10 years on average, because the Fed is expected to come down to say 3.5% or so. But I would say that the market is pricing in this premium for uncertainty, that there's the potential, the market in the last few weeks, as interest rates kind of rose, that was a result of inflation expectations kind of bumping up a little bit, that the tariffs might be a little bit longer lasting than people expected, which could mean that inflation is going to be a little bit higher. But in the long run, I would say that the 10-year is very much reflecting the expectation that, yes, the Fed is going to get to a point where interest rates are likely to be lower over the average course of the next 10 years. But right now and in the short term, the market is really wrangling with this uncertainty of how much inflation is this all going to cause, and where do the tariff policies all end up? And the truth is, nobody really knows. So we're all kind of waiting to see where this is all headed in the short term. All right, BRIPC23 asks, where does Rory's shot on 15 rank all time for you? That was an awesome Masters yesterday. The shot on 15 was great. I think he missed the putt though, didn't he? And so I don't know, that kind of diminished it. It was an incredible shot, incredible performance by Rory, but I would say that missing the putt is kind of a bummer afterwards. So it diminishes how great. It's definitely, I would say, in terms of the Masters, it's got to be a top 10 all-time shot for sure. But come on, I mean, like nothing comes close to like, Tiger's chip in on 16 in, 2005. Those sorts of shots they're in a whole other level, I think. So great shot, great tournament. But I don't know. You can't miss the putt after that. All right, G asks, will any of this actually benefit regular people? So like I alluded to earlier, tariffs are ultimately they're tax increases on corporations that get passed on. One of the reasons economists hate tariffs especially is because they're a super regressive form of tax, meaning that they hurt the poor and the middle class the most, because they hurt necessities, because necessities are one of the big items that we import the most of. And so these hurt poor people more than they hurt rich people, especially in the short term. I think this is all going to come out in the wash in the long run. A lot of people are talking about how, rich people are going to be hurt by the stock market. And for the most part, rich people don't care what the stock market does in the short term. Some people do, but for the most part, the average, I think, sensible, long-term thinking, wealthy investor does not care too much what this does to the stock market in the short term. So this is not going to impact them in a huge way, but this has a potential to be hugely disruptive to poor and middle class consumers in the short term, and that's really bad. So I think that if we start to see that come to fruition in the data, I think a lot of this ultimately gets peeled out. But in the short term, this stuff is not great for the poor and the middle class. So I wouldn't say that a lot of this especially in the short term, is beneficial to the people that they think really need the most help from all this. Shane Moser asks, if we have a recession, will Treasury still be a safe haven? Well, it depends on how bad that recession would get. If you get a deflationary recession, I think you're going to see the Fed's going to come in, they're going to reduce rates. They might even do quantitative easing, which is Lucas's question in the next one. And I think that if things get bad enough, you get QE, you get falling rates, and the Fed comes in with the big bazooka. And in that sort of an environment, the whole interest rate structure falls, because the expectations of where the Fed funds rate is going to be over the course of different time horizons has to shift down. And so the yield curve in that environment probably steepens a lot, because short-term rates are going to come down more acutely than, say, long-term rates will. But I do think that, especially if you get a deflation, you are definitely going to get, I think, a situation where long duration bonds increase in price, mainly because they have to reprice the Fed's expectations of where they're going to be in response to all of this over the course of the, say, next 10, 20, 30 years. All right, James S. asks, do I need to be worried about the safety of instruments like T-bills? I would say almost definitively no. Treasury bills are guaranteed by the full faith and credit of the US government. In my opinion, I mean, these instruments are even safer than holding like an FDIC insured bank account or a high yield savings account, because unlike those things, which are really just insured by the FDIC and up to certain limits for certain banks, the Treasury bills, they are even better than all of that because they're guaranteed by the full faith and credit of the US government. And even in this sort of a wacky environment, the US government and the US financial system is still, it's so large, so productive, so profitable that this is still by a huge magnitude. Even if you're diminishing this to some degree, this is still the safest of all the fiat currency systems. So even, I often say that if the dollar is a dirty shirt in your closet, it's the cleanest dirty shirt compared to almost every other fiat currency, even on still on a relative basis, no matter what all of these tariffs end up doing. So no, I would say those short duration instruments like Treasury bills, you really don't have to worry about the principal value of those things, especially if you're buying really short duration ones like 3 and 6 month T-bills.